Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Tuesday, January 18th, 2022. We're starting off an abbreviated trading week. Markets were closed yesterday in observance of Martin Luther King Day. We'll pick it up here. We're going to go over the equity markets first. Might do a quick update on the VIX. And then just some of the things that stand out to me right now is potential trading opportunities, Treasury bonds, silver and gold. And then I'm also going to go through, you know what, I'll do this in the beginning. Let me loop back. I'll cover the 11 sectors in the S&P 500, and then follow up with just maybe a few other trade ideas, lumber, crude oil, and nat gas. Let me write that down on my notepad here. I wanted to do an update there. Okay, so that's a lot of stuff, but we won't spend a lot of detail on the equity markets. You know, my long-term outlook hasn't changed, nor is my near-term outlook. So if you're just catching up, just reference some of the videos over the last week or two. These are the levels we're still watching here on QQ. Like we're on NQ down here. I'm sorry, I was looking at another monitor with a QQQ chart up. There's potential divergence. I'm going to point it out, and it could certainly play out. Remember, it's these divergent lows that usually spark rallies, and the divergent highs that usually mark turning points where you get corrections. That was actually our divergence right there, divergent high right there, correction. And so we'll watch that, but we're precariously close to that key support right here at about 15,133 up to about 15,170 on NQ. That's what we're looking at here. Let me pull up the QQQ 60-minute chart. That's what it looks like on the daily chart. Remember, big picture has us just below this recent trading range, or this key yellow line right here that I figured was and still is a significant support level. But once we took it out, remember we had that reaction low. The dip buyer stepped in and bought it up that day, but we're back down. We faded almost all of that rally again from last Monday, the recovery off the lows when we briefly took out the next support down below 373.14. And so, I continue to maintain that, staying short, recommended or suggested, again, to each their own. I thought the risk reward was worth going home short over the weekend, and so far paid off. Nice gap down today. We're down about almost 2%, 1.75% on QQQ right now. We're a little bit off today's lows. But let's zoom down to the 60-minute chart. So that's it. The 60-minute chart, check, check, check. We're moving, where I figured we would, but a little bit slower. We hit T1 way back here, and then T2 that same day. Had been bouncing, moving sideways, finally hit T3 and T4, and that's where we bounced, and that's where it was suggested for active traders, game of bounds, go long. And so far, we're moving down again. We faded almost all that rally so far, but not all of it. And so once we do, undoubtedly, there's quite a bit of stops below that level. And again, I think we'll hit it. But if you want to play it safe, if you did take some shorts home over the weekend, or or let's say you didn't, and you wanted to short or add to shorts, then you might want to wait for a break of that level. We can also look at it this way. Let me turn off all the lines, show you one thing. You have this potential bear flag here. You had an impulsive move down right there. Your little bear flag right there, and we gapped down today, and that's what you want to see. Even though there's a gap, that's even better than an impulsive drop. In other words, one big red candle down through there below the flag, because what a gap does, as I talk about it often, gap downs, they trap longs and they deny exits to want to be shorts. It keeps the short interest a little bit lower, which is good, and that then creates the fall. The potential for a drop sooner or later. If we start to fall, you should see some longs get stopped out or panic out, and then the some shorts pile in. Either way, let's just play the technicals. That's what we're talking about right now. There's the flag, impulsive drop down. But we still have to take out those lows. There's, the bulls are certainly trying to defend and buy that low, and again, I think it'll go. And if it does, I'll do an update, or, well, you'll know it when you see it. It'll probably start to be a pretty quick slide after that. Or if we happen to reverse, whether we dip down below there briefly and reverse, or reverse from here, I'll certainly do an update and keep you guys updated on the market. And of course, there's always the S&P 500. A lot of traders watch that. That's what the mainstream media focuses on most often, and so we certainly need to see that go. So that would be your key level. Again, this uptrend line that comes off the October lows, early October lows, and we're below it now. But you have, if you look at it this way, this shaded box right here. I don't know if you can make it out in the video, but I have a shaded box through there. If I extend it, it comes right here. So that's really, and again, that's a little bit below. We're close to Monday's lows now, but from the bigger, and that will certainly obviously be a bearish thing to take that out. But from a little bit even longer term perspective, down here, so roughly about 450 on SPY right there. That will take us down below this multi-month consolidation range again since the beginning of about the middle of October right there on SPY. We've been bouncing around in this range. So those are the levels to watch. And one development we'll keep an eye on, I showed you had some potential divergences on the NQ chart. Right now, SPY is making roughly an equal low with where it dipped down to last Monday, and the indicators are making slightly higher lows, and that is positive, or aka bullish divergence. Now it's unconfirmed, or what I call unconfirmed divergence, because the indicator is still pointing lower, and we could burn through that divergence. So that's what we're going to need to see. I want to see that to give a check mark for the bears. I want to see these divergences get burned through. I suspect they will. I'm staying short for now, but should they firm up and we get any kind of reversal sticks or anything like that, then that might be a sign to start covering shorts, or at least tightening up stops. But again, we'll take it as it comes. As of now, I reiterate my near term and intermediate and quite likely longer term bearish outlook. Well, again, longer term, we're talking months plus. We'll see. We got to take it one day at a time. We are still solidly in a bull market above all the key longer term trend indicators. Most of those are still quite bullish at this point in time. But if you wait for the longest term indicators to roll over on the monthly and weekly charts, by the time that happens, you're already down 20-30% on your portfolio if you're, again, if like a 401k investor or anything. So active traders, we let the near term charts be our guide, 60-minute daily charts, even the weekly charts. And so as of now, nothing's changed, but just a little more work to be done, just waiting to firm up a few more check marks. And if we get that, those additional check marks, in other words, some of these near-term support levels taken out, I think we'll get to that point where you start to see that, what I call waterfall selling, where you get a 3% plus down day, followed by another 3% down day. All the rips get sold into early, and that's when those short positions should really start to shine. All right, let me go through the sectors of the S&P 500, because an index is simply a sum of its parts. So there are 11 sectors within the S&P 500. I'm going to rifle through these very quickly in order of their weighting. But before I do that, it just jumped out to the daily chart of SPY. And again, this is that multi-month trading range I was talking about a minute ago on the 60-minute chart that we need to take out. And the bottom, again, right there is about 450. And it would also mean a failure of this breakout to all-time highs. See, we broke out. We then broke out again to all-time high here. That one failed, so that was a what we call a bull trap, false breakout. And now if we solidly move below 450, it's going to mean this breakout above that high failed, and that's even bigger. That you kind of zoom out to the weekly chart, and that shows pretty well. And then it'll open the door to my intermediate term and longer term targets, which are all listed here in SPY. I think that has the potential to take us all the way back to 397, but first things first, let's see if we get the sell signals. All right, let me rifle through those sectors for you. And this kind of paints the overall picture. I'll just hit on each one briefly. Most key points is XLK, by far the largest, 25% or so weighting in the S&P 500. It's over half of the NASDAQ 100. So where this sector goes, the market goes. Make no mistake about it. And it has peaked way back here, mid-December. And it did so putting in a divergent high. In fact, we've been having divergence building for quite a while. And each divergent high has resulted in a little correction, but each new divergent high is simply an extension of the previous divergence. In other words, the divergence grows larger. They're not separate divergences. They're just an extension of the larger one. And again, the other previous divergent highs have played out for corrections, tradable pullbacks, and sooner or later, usually when divergences get this large, they then play out for a much larger correction or bear market. So levels to watch, I have a yellow line right there, and 160 I think should do the trick for the tech sector, XLK. Again, that would be a failure of this previous high right here. Let me circle that actually. Previous all-time high, there was your breakout, and we haven't even back tested it yet. So if you're bullish, this is where you buy. You step in and buy the back test of the trend line, 160, the price support level. And, you might want to allow for, I'll tell you, if I were longer term bullish and looking for substantial new highs in the market, I would start buying there and down to, but not below. I have the levels turned down, the brightness turned down, but there's the 200-day simple and exponential averages. They're flattening out on each other. They come in like this. And so what I think would be the most likely bullish scenario, it's not my primary scenario, but I think we'll probably undercut those, clear stops, hit the 200s. That's usually where buyers step in. If they don't step in at support. So, I would have, if I was a long-term bull, I would scale in from there down to there and with stops somewhat below. But I think that's going to break, and I think we're going to slice through there. We may or may not even have a reaction on the 200s. And I think there's a lot more downside to come. And again, a lot of that's formulated based on my view on the weekly charts and even the monthly charts. A lot of thin air down below. And that's why I think not only we're looking at a sizable correction coming, but I think if we can break those levels, finally get the momentum turned, it should be a pretty swift and profitable ride down on the short side. XLK is the top component. XLV is the second largest at about 16%. I haven't updated these numbers in a couple months, but they're roughly around there. And same story. The divergence been building, negative divergence. And there was our primary trend line right there. It broke down. And like so many things, that was really about where the market peaked. In some, but not all sectors and stocks, we made marginal new highs. And those marginal new highs were simply an extension of the divergence. Sometimes you break down and never look back. Sometimes you break down, you have a little snapback rally that takes you above the breakdown point. But again, most importantly, we're below the primary uptrend line. We put in a larger divergent. We've had these little mini uptrend lines. That one broke. And now, if you look at it this way, turn off all the lines. Remember, there was our all-time high. So there was our breakout to new highs, right? And a back test right in there as well. And now a failure, a clear failure. And if you look real tight, here, I'll do it this way. Put the lines back on. I'm going to move that. Yeah, well, I'll leave this line here. So that line I just put at 137 was the high. And there's the breakout. So once we failed it, we came and back tested it. Resistance, and we fell. And if you look at it this way as well, just so much to see in the charts right now, and so many, I'm seeing bear flags everywhere. Look at that. Impulsive leg down, a textbook flag pull, followed by a period of consolidation, followed by an impulsive break. And that's going to take us down here, the measured target to the 200 days, and that's the healthcare sector. And again, second largest weighting in the S&P 500, so it's going to be hard to see the market going up with both tech and healthcare falling. Financials, I've updated these recently. No change really since back here. We had a major high. We tested again, failed, tested, failed, tested, failed, tested, failed. Finally a breakout. Came back in, moved through it a few times, started to move above. Everybody was giddy on financials recently, all the analysts, because rising rate environment is going to help the banks. It increases their spread, and what that means is spread is the money they pay you on your deposits, checking, savings, money market, versus and what they turn around and lend that money out to. So if they're giving you 0.5% on your checking account, and all of a sudden car loans and mortgages and boat loans, they go up higher rates, they're collecting higher interest, increases their spreads. That's why Wall Street got all giddy on the banks, but I haven't waffled on my view that I think I called a major top in the financials there, and we only went a few percentage points above. In fact, we're still only trading about 1% or so above it, and I still think there's a lot of downside. We already hit my first target early on, T2, T3, Nothing's changed. The divergences continue to build, and most recently we took out the minor downtrend line, gives us that little wedge there, and then boom, boom, boom. So we already hit my first target. Well, now I would, if you're swinging the financials, and you can use one of the ultra short ETFs like SKF or FAZ. Those are the 2 and 3 times short. Or you can just short XLF if you don't have to worry about decay. 37 is your first target now at this point in time from right here, and then sequence or just change out, or you look at my previous targets T1, T2, T3. XLC Communications. This is chock full of Facebook and Alphabet. They make up almost half of the darn ETF or the darn sector there. That was a major top. It was a clean trend line, and it broke. So here's a sector that peaked all the way back in the beginning of September, late August, right there, and has fallen so far from the top there. It's dropped about 14%. And so this is a story. There's quite a few stocks already well into correction, some even into bear market mode if you want to use the 20% definition, and even some sectors here. Yeah, that's it. So that one, again, no signs of reversal there. XLY is consumer discretionary, and that you can see a big level here. Let me color these lines up for you. That shouldn't be. I'm just trying to color code. Yellow lately is the key levels to watch that, if taken out, should trigger another wave of selling, and that would be these two lines right there. So about 192, we'll call it. That should open the door for a move down, and change that one up. Just put it back white. XLI Industrials. Here's one. We had a nice trend line there, and we put in a divergent high, but nothing happened. We broke down, and here's the thing. The industrial stopped going up. That was back in the beginning of the year, last spring, in April and May, right there. We peaked and broke the primary trend line and never went higher. We've been moving sideways since. I'm going to get to IWM here in a second because I just got a price alert. But let me finish up the sectors. We're almost done. XLP Consumer Staples, what stands out to me, Staples rallied recently. That's usually where institutions and savvy investors will flock to when they expect a slowdown in the economy, because those are your safe, steady Eddie companies, Colgate and toothpaste, deodorant, beer, alcohol, things that people keep buying, paper towels, stuff like that. And it had a nice ramp up, but the technicals say we're going to have a broad-based sell-off. In my opinion, this sector broke down from that bearish rising wedge, had impulsive move down, aka flagpole, little bear flag, and today broke down. So I think we're here, guys. I think this is where we'll start to light up those shorts. 73.30 is there'll be a couple stops along the way, but I think we'll get down there. XLE energy sector, a lot of hot air in this one. I think as soon as the market, not as soon, either as soon as the market starts to correct and those support levels give way, or shortly thereafter, the masses will then extrapolate that the weakness in the stock market is predicting weakness in the economy, yada yada yada, and therefore they'll start selling oil in the energy stocks. And if you shorted XLE today, which is not below the trend line, but I might layer in this one. I don't have any energy shorts, but I might short the sector or some individual oil and gas companies. I'm going to give you another target, and it's right here at about 59.20. We'll call it 59.30. That'd be about a 9, almost 10% drop there. That's again a minimum target on XLE. XLU. There's another defensive sector. But see, what happened is the Fed's really screwed this one up. They've really put investors in the market in a pretty ugly position longer term, in my opinion, because by artificially suppressing rates so low for so long, taking them down to zero and keeping them there well beyond the point that they should have started raising, it's forced institutions and investors, think of a grandma, out there looking for income, and she's not getting it on her CDs anymore. The banks has long since paid 5% or 4% on a CD or Treasury bond from the government. And so they've been running into defensive issues and things that pay dividends, such as utilities. And so normally you might say, Randy, why don't I buy utilities and REITs right now? Those are defensive sectors. They should go up in the economy. Well, because what the Fed did, it ran a lot of money into these things chasing yield. And now with interest rates going up, unfortunately, that's exactly what REITs and utilities, they don't want to see. Rising interest rates are going to hurt those. These are rate sensitive stocks. They do well when rates fall, and they do poorly when rates go up. And if you just want to look at the technicals, forget about everything I just spewed out a minute ago. That's all fundamental analysis. Technical analysis says we just put a divergent high. Look, I wouldn't. There's way better sectors to short. If I had to be long or short XLU, I'd probably go long here for a bounce. We're at support. I think we'll probably get a bounce, but ultimately we may work our way lower, especially again if it's a broad-based sell-off, just simply from it being a component of the S&P 500. And then the REITs, I showed you. XLRE is from Spiders. That's the same company that runs the SPDR. But I'm going to show you IYR. It's just first to market REIT ETF. We have an official short trade on this one. And you can see it's played out nice. Flagpole, bear flag right above the primary trend line. On Friday, I gave you the update that we took out that trend line, and now we're clearly below it. There's that measured target for the flag, my first target there, 105.36. Again, unadjusted targets, actual support levels. You might want to cover a hair above the level or levels that you are targeting, but I have zero interest to cover my REIT shorts until we get down at least to that first target. I'll see where things are at in the market. I might let it just morph into a longer term swing short and ride out and hold out for more, but ultimately right now this is my current final target all the way down to 84.85. And on SRS, so if I'm predicting a drop, which I am, ultimately of 24% in the REIT sector, depending on how that plays out, SRS, which is 2-time leverage, could easily return over 50%. And the way it would do that is if you get a fairly swift unidirectional sell-off. In other words, minimal green days on the upside, rallies that close up. That's where the decay starts to kick in, and so that leverage can work in your favor or against you. This is exactly when you want to own it. Here, I'll show you an example. I'm digressing. The video is going to go forever, but I like to do this from time to time. I know there's new people on the site. I've done this for years and showed you. We'll just look right here. IYR, if you shorted, IYR right there. And it tracks the same exact sector as SRS, so that's why we're going to look at it. The REITs dropped 44%. That's in the box on the bottom, towards the bottom in red there. 44% right there, down from that peak, and that was from the drop right there in February down to March, right? So we go to SRS, and I haven't done this yet, but you'll see it almost every time like this. So you grab that low. Remember, it's just looking at the chart upside down. Instead of 88%, 44 times 2, you got 156. That is how that leverage. And I harp on this because I'm sure somebody else has finally picked up on this, but all I ever see out there in the media is they curse these things and they say they're the scourge trading. They should only be used for day trades, if at all. No, they're great for swing trading. You will outperform the leverage factor if you can time it right and get. Now, it's not always so easy to get in those unidirectional rips, but quite often it is. So just food for thought. And if you want to really juice it, I don't know if they still have DRN and DRV. Yeah, they do. DRN is the 3-time bull, and DRV, is that one still around? Yeah, 3-time bear. So you could juice your leverage up to 300% if you want. But whether we're going to get that waterfall sell, we haven't even broken last Monday's lows yet. So first things first, I think it's going to happen. And if you take it, the thing is, if we reverse, or let's say we get a little whipsaw signal down below Monday's lows and then a strong rally and divergences are confirmed, market breadth looks good, everything else, then you just stop out. Don't fall in love with it. That's where you'll get killed on holding. If you're wrong on those leverage ETFs and you hold them for too long in the wrong direction or in a choppy sideways trend that can go on for months, that's where you're going to lose money. So it's like everything else, any trade you take. Have your price targets, your profit targets, where you're going to take profits if correct, and have your stop loss levels, where you're going to exit that trade, whether it's a hard stop or you're going to layer out, scale out, just like you scale in. All right, moving on. That's it. Other than XLB for the sectors of the S&P 500, this one won't even move the needle. It's only a 2.5% weighting, but The thing is, all of these charts are just telling me the same thing. They're saying, right now, at least the way I see the charts, it looks like a broad-based sell-off is coming. I don't see a sector in the S&P 500 I'd be comfortable with right now on the long side. XLB, if it breaks this wedge that I just drew right here, support about 86.56, that should take us down to about $79. That'd be about a 10% drop. And maybe I'm wrong, and maybe the market's right. By that I mean the market's not afraid. And I actually do like that. Not kind of like, I like that, the fact that they're not showing any fear yet. It shows me that people aren't loading up on a bunch of puts right now on the market, because the VIX is still low. The VIX is, derived from put and call buying, and that's where when people stop buying calls, they start loading into puts. That's where the VIX spikes. So right or wrong, now sometimes the VIX is correct, and it's saying, hey, although Randy, you see the market on the verge of a technical cliff. If we can just, drops a little more, it's going to have a big slide. But however, maybe the smart money sees otherwise, and that's why the VIX is not moving. Now, the takeaway from this, guys, is, and again, you're going to have your own view. Don't go by mine. My analysis is just what I see. Take it, factor it into your own. It may mesh with yours. It may contradict. Maybe I show you something I see that you didn't. A lot of times you guys point out things that I missed, and I appreciate that. Keep those coming in the comment section. But here's your trade idea. If the dam breaks here, VXX, I've given you targets recently, T1 through T5. This is one of several ETFs out there, ETNs, that track the VIX. Now, with the VIX, you can't trade the spot VIX, VIXX, that I just showed you. That's the index of spot VIX. There is no trade on that. You can't buy it. You can't sell it. What you do is they have futures on the VIX, and then they have options on those futures. So you can either trade the futures directly, the options on those futures, puts and calls, or you can buy one of the ETNs that does invest into the futures for you. And that's when this one goes into the short-term futures, just like what is it, UVXY, I think. And there's your target. So if we continue to move up, we're coming off the divergent low so far. From the lows, we've moved up. That was last week, about 12%. But to my first target, let me just show you from where we're at today. First target, if hit, it's going to take us up about 25%, and the maximum target's going to hit gets hit. That's about 120%. And that's VXX. That's the trade idea for you if you want to get a little more aggressive. It's going to move inversely to the market. So I'm either going to be right on my call on the market and then right on this, or I'm going to be wrong on both, most likely. Almost certainly, actually. Alrighty, next up, Treasury Bonds, TLT. I gave you an update this morning, so no need to harp on it too much. I have a support zone right here that runs from about 140.69, give or take. It's up to about 141. We're at the bottom of that support zone now. It's a pretty good support zone. See back here? We had quite a few reactions along there. Check, check, check. Finally, a breakout back test, and we moved up, and we checked it again there. So that's the case. Now, if you want to play the glass half empty, I'm playing the glass half full right now, sharing that as long. That's impulsive selling. That could be a bear flag, flagpole of a bear flag right there, which just broke down, and that could take us down to some of these lower support levels. However, should the dam break in the equity market soon, or even if it doesn't, I think the institutions are going to hedge up and start buying some treasuries. Now, rates have been going up in anticipation of the Fed hikes. But remember, the Fed only controls the short end of the yield curve. They control the federal funds rate. TLT or Treasury bonds are going to, this is tracking the 20 to 30 year, really mainly the 30-year bond. And in that, where that goes will be determined by the market, number one, but it's going to be reflective of two things influences. Of course, rates going up or down, but what influences long-term rates going up or down? Supply and demand. When there's a lot of volatility in the market, especially during a strong sell-off, institutions will flock to treasuries for safety. They'll buy them. And the other thing is economic future growth expectations. So all of a sudden, if growth expectations go lower, right now everyone's finally talking about, everybody and their brother is finally on board that inflation trade. We've been on for a while now, for years with the commodity, and even Powell has pulled a complete 180 at this point. And so, the inflation trade says longer term rates up. That's why we've had this sell off in treasuries, right? But if all of a sudden the talks turn to, well, yeah, inflation's a problem, but we're also going to have a slower economic growth, that will bring down long rates. A lot of there's been increasing buzz of the word stagflation, which is when you have inflation plus stagnant growth, and so that's and what I'm pointing at these arrows, by the way, I'm talking about rates, percentage interest rates, and remember TLT, which is what we're looking at here, moves inversely. So this is bullish for TLT. This rates, if we're talking about rates up here, makes bond prices go up. So didn't mean to be too confusing there, but I know I have to clarify that. These are what the rates look like. TYX. This is the yield on the 30-year bond, and you can see big resistance right there. Remember, look at all that. This is just TLT in reverse. It broke down there, back tested, just like TLT broke out, back tested I showed you a minute ago. Checked it there, and look, we're at there again. So the long bond is at resistance, or close enough to it. You had that reaction high right here. So really call it a resistance zone from where we're at right now, that previous reaction high, up to back where I had the line from before back here. And so that's why I don't think that flag, which would be a bull flag here, is going to play out. I don't think we're going to pop right through that resistance level without at least a reaction. So, consider it just and that's what I've been in, hit and run mode with treasuries for a long time now, meaning swing trade, get in, get out, get a couple percentage points. That's all you're going to get on bonds on a short-term move, and then move on to the next one. Okay, next up, still like my silver and gold. Every now and then I'll revisit the long-term chart of gold. This is GLD. It's been hit my buy zone. This chart looks so messy, you probably can't make heads or tails out in the video, but forever and a day, actually back here, when I made a call to get out of gold, looking for a major correction, even swing and trend positions, after being bullish really since the bottom back here in 2015-16. We've had what I believe to be a multi-year correction. I know that's a messy chart, so we just look at the weekly chart and we can see it clearly. So this is what I view as a bull market corrective action. Remember, there was our low. It occurred in December of 2015 right here. We went up there. This, to me, was a very big level. And before it even happened, and after, I said if that would break out of that would be powerful, because we had that trading range there. And that was the catalyst for that huge run up in gold. And so gold bears see this. They see this period back here. Oh, we're at the same level, and we had a bull market there, and it went that way. I see gold coming up from a higher level. Remember, that was an extended bull market, and then the bull market was over. And we also went bearish and short on gold, called a major top right there with the blow off in gold. And so there was your bear market in gold, and this was the start of a new bull market. And based on my analysis, again, I believe that this is just a corrective, correction within an ongoing bull. It's a nice, clean, symmetrical triangle pattern when you look at it here. So we can get upside break. It should run us up to, and we've already checked that previous high. Remember, that was resistance. That's why we got out of our gold positions there, because that was a major reaction, last bull market high. But we already hit it once, so we could probably it's quite likely we can blast on through there and not have to have another reaction. We'll see. First things first, we've got to break out. For that, we'll just continue right now until we take out the recent highs. We're in this range, and it's somewhat sloppy, but there's been just tremendous amount of trading ops pointed out. Look at these divergent highs, divergent lows. Just swing these highs and lows, divergent high, divergent low. That one, I gave you my thoughts here on that one. I said, look, I acknowledge the divergent high. I've acknowledged the breakdown in the euro. We hit my price target recently, my second target, where I expected a reversal. We got a reversal. It's still going, but exactly what I predicted is happening. Remember, here, let me show you what I'm talking about. I told you last week, after that buy signal back here, the bullish fall and wedge breakout, we set up in a consolidation zone, and I said next buy signal on a break of 114.09. I give you all these targets, 1, 2, 3, 4, but said, look, we have negative divergence, and so expected a pullback. We got a pullback. Came down to where, and it did bounce, but then now it's broken that as well. So this is a big drop right now in the euro, and you would think that gold would normally have dropped a lot more because gold is positively correlated to the euro, but it hasn't. It's holding up relatively well, and that tells me that the impact of a rising dollar slash falling euro is being offset by demand for gold right now, and that's why gold is, relatively speaking, holding up against the drop in the euro and the rally in the dollar. And you still have this primary trend line right here. It's still well above. So I still think we'll get up there. And you know, the US dollar, remember on that, we hit at the same time euro hit resistance where I thought we'd have a pullback. The dollar hit support where I thought we'd have a bounce, and we got it. But look where we bounced back to now. The dollar has bounced back. That was a support zone, and now it's a resistance zone, and we're right there. We're right at the top of the zone at 95,784. The dollar happens to rally more. You still have major resistance at the top of the range, but we're at the bottom of the range. So I think this will happen, and if that does, that should turbo boost gold and silver. Let me get to silver for you real quick. This is what silver looks like on the 120-minute chart. And as I told you last week, we broke this trend line, and that's where, and especially with the drop in the euro, normally you would have saw this or the move down to the next, you know, challenge of lows, a much bigger drop, maybe even a breakdown. But instead, what's happened is, no, the buyers are gobbling up silver despite the rally in the dollar and the drop in the euro. Silver is just taken out the breakdown point, and so I still like these guys. Anyways, it's all part of diversification. Maybe I'm completely wrong on my call on the metals, but then I'm, you know, making money on the you know, index shorts or REITs or lumber or oil. Here, let's move on. We'll get to those other ones. So I've already covered the REITs. Let me show you. We'll start out with soybeans, just a couple of the ag commodities I've highlighted recently. I shared this one as a trade setup a couple weeks ago on a break below this bearish rising wedge pattern with a secondary sell signal or confirming sell signal on a break of 13.71.300. We got it. We had the breakdown back test, and we broke that. Now we broke we broke 13.71.300, and now we're currently back testing. So there's an objective level to add to a short position for my next target and or final target down here at about 12.98, and the intersecting uptrend line. That's where I think we're going in soybeans. Sugar, just an update there. I gave you a buy signal back here when we hit the 20 level on the RSI and the low level bullish PPO crossover. So far that's still in play, and usually those end when you have either the run up to the 86,275 level on the RSI that usually checks the rallies, or a high level bearish PPO crossover. So not enough juice left in that one to be in it, but we'll be on the lookout for the next sell signal if we get those, any or especially both of those sell signals I've talked about. New setup for you here in cocoa. Cocoa looks ready for a drop. You have an uptrend line here. You have negative divergence. So break of the uptrend line, and that should take us back at minimum that 2600 level there, and quite likely some of these lower targets. So that's a setup because we're still above trend but close. So look for a break of that. Another one I like right now is lumber. This is a, what are we looking at? 2-hour candles. Lumber is just looking ripe, and lumber is really, it either is going up or down, usually not anywhere else, and usually not sideways very long. If you had a minor trend line here, I highlighted we had a break and pull back there. But this larger, this is a wedge now in a longer term uptrend line with nice negative divergence here on both indicators. Back then you did not have it here on the RSI. You only had divergence on the PPO right there. And when we look at the long-term, that's right here. This is lumber futures from a longer term perspective. And hopefully you can make this out. I'm going to scroll it in here. Let's see here. Well, it's a little bit zoomed in. You can pull up, it's $ lumber if you're using stockcharts.com. You have a very steep uptrend line right here, and complete with negative divergence, still unconfirmed. And the way lumber works is usually when it breaks, it's a pretty straight shot down. So This one will, and it's been going up because the stock market has been holding up relatively speaking. You know, the S&P is still not very far off all-time highs. So lumber and crude oil, and again, just to time lumber, go to the shorter term charts on lumber future. We're cracking, but let's see a solid candle close below or move even intraday down below that rising wedge here. Again, this is a 120-minute chart. You can replicate it also on an hourly chart. And, I think we'll come all the way back probably down here to 861. That'd be a nice drop if it gets there. It'll be a drop of about 32%. And that one will be most likely dependent on if the market rolls over, because that will indicate slowing growth, and therefore the outlook for the home building industry and all other things using lumber should slow. So we'll see. It's sort of contingent trade, and a little bit of work to be done. Oil. Let's look at crude oil, natural gas, and wrap this up. CL, I'm still very much looking for a major top on this one. We had big resistance back here back in October last year. Multiple reactions there on that level. We're just a hair above it. Looks to me like it's a whipsaw. Will prove to be a whipsaw. So you want to see it come down and then take out the primary trend line. This trend line comes off the mid to late, really mid-December lows right here. And I had to roll the future, so I don't have the levels that I had marked before. But this is, to me, kind of a tuck it away, especially if the market breaks. And let me say this. If you had, let's say, for whatever reason, your broker would only let you trade one position, and the market breaks down, we get those solid sell signals, confirmation I'm talking about, and you could only trade one thing. I think you're going to get a lot more bang for your buck shorting crude than shorting the equity markets. Because remember, if you go long or short the S&P 500, you're buying a basket or selling a basket of 500 companies in 11 sectors in many different subsectors. And some will be going up at any point in time, some will be falling. And NASDAQ 100, again, the 100 largest companies in the NASDAQ 100. So oil is more of a pure play. It's almost akin to going long or short one single stock. And you get more bang for your buck when you do that. And it also tends to fall a lot more. It has a higher beta compared to the stock market, meaning it'll go up or down more in percentage terms during its trends. So we'll watch that one. I'll let you know if it breaks down. I'll give you an update, and then that one again looks like it has a lot of potential to fall, especially if we get some confirmation with the stock market breaking down. And then last but not least, I'll give you a couple contracts. NG recently. Which one? Let's look at the March. We already rolled out of the February's, didn't we? Yeah, there's the February. So let's focus on the March right now. Downtrend line, uptrend line. We broke out. That was a long on the breakout. Pulled back, and there's the uptrend line. So as of now, the indicators aren't telling me too much, but we know we're in an uptrend. The breakout's still intact. So you can buy pullbacks to the trend line with a stop somewhat below and swing it up there all the way to that 445.20 target, because we fell a little shy before. Wow, long video, and I'm going to wrap it here, but as earlier in the video, I got an alert on IWM. Now, we didn't break it, but we kissed that level. I had alert set at 208.48, and again, that's a rough approximation. It's a $208 security, and we're right there. So look, bulls can take, the onus is on the bulls to take the ball and run. The onus is on the bears as well. I should say it either way. Whoever, it's anybody's game here is what I'm trying to say. Bulls need to step in here, so they can buy IWM even on a break below. If they can reverse it, they'll have positive, aka bullish divergence, and they have the potential then, if we can get a breakthrough here and a reversal, that would be a bear trap. Very bullish if that happens, and especially if they can build on it, and again with positive divergence. Otherwise, what the bears need to do is take it down, take out 208.48 with conviction. The farther they go away from there, the better they are. And then if they can burn through these divergences by putting lower lows in the RSI and PPO, we're going to hit my 170 target, or at least I'd put good odds on that. And that's, again, a pretty aggressive target, pretty big drop. But I think it's the most likely scenario at this point in time. So key is stay flexible. In other words, if you get the whipsaw scenario, I'll try to address it as quick as possible. Sometimes it'll whipsaw through, back up, and then down. You know me. My updates will increase with frequency with the developments in the market. So if that happens, I'll get things out to you as quick as I can. But this is it right now. I think if you're short IWM or have been, I just continue to hold. Give your position some room. I'm sorry, and because you're swinging down from where we're at another 20%, you may have been short from up here somewhere anywhere else in the middle. I'm going to wrap it up here, guys. This has been Randy Finney with the Right Side of the Chart. Have a great day.